Welcome to Raise Your Average. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. Co-hosting with me today is Adam Butler, CIO at Resolve Asset Management Global. Aahan Menon, founder and strategist at Prometheus Research, is here with us. Aahan, welcome to the show. Thank you so much for joining us.
Pierre, thank you so much for having me on. It's a pleasure to be here. I've heard some of your shows before, and I'm really excited to contribute.
Awesome. Yeah, I had a chance to listen to one of your podcasts, the most recent one that you did with Andy Constan, and I think that was your most recent episode, Andy, who was previously with Bridgewater, right?
Yeah.
And
yeah.
So how's it going? Where are you coming to us from?
I'm coming to you guys from sunny San Diego.
No, that's nice. How's the weather?
Yeah,
it is nice.
Yeah.
Yeah.
Can't complain. I mean, well, lately you can, but
yeah.
We've had a bit of a turn with the weather recently, but today is a little bit nicer. So I'm actually talking to you guys from outside for those guys that are listening.
You're not getting the blizzard.
No. We actually had hail. I would say day before yesterday.
Yeah.
Which has got to be pretty unusual for you down there, right?
Oh, yeah. Extremely. Yeah.
Once in a 39-year event. Okay.
That's right.
All right. So Aahan, I want to introduce you properly here before we get started. Aahan Menon is founder and chief strategist at Prometheus Research. Aahan is a highly regarded expert in the world of quantitative macroeconomic research and provides elite market findings and economic insights to the public and institutional investors through Prometheus, and publishes his thoughts in his very popular Prometheus Research Substack. Prometheus is known for its data-driven approach to delivering real-time insights into the evolution of markets and the economy. Through this approach, he and his team have been able to combine their insights algorithmically to create rules-based portfolios that help guide investors to achieve equity-like returns with much lower risk. Prior to founding Prometheus, Aahan gained a well-rounded perspective of markets through his work in the retail research business at FXDD and on the buy side at Light Sky Macro. Aahan holds an undergraduate degree in finance from NYU Stern School of Business.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Did I get that right?
You nailed it. That's everything.
Right on. All right, I'm relieved now. I can relax and okay, good. So, Aahan, tell us about the arc of your career, how you got started, what inspired you to start Prometheus. First, how you got started, and then what inspired you to start Prometheus Research, and what sets what you do apart from other quantitative macroeconomic research firms.
Yeah, I'll actually, if it's all right with you, I'll take the first half of the question first, because I think that we can probably work backwards a little bit. And so, as you mentioned, I'm the founder of Prometheus Research, which is a systematic macro research firm dedicated to the democratization of finance. And so what we're trying to do is we're trying to create the best macro research engine in the business and make its insights available to every investor regardless of their size. Essentially, we're trying to create a moving picture of the economy, which we can leverage to help investors make smart investment decisions over the course of the economic cycle. The way we do that is relatively unique in that we spend a lot of time trying to understand how the economy and markets work, so we're really mechanically focused. And we're constantly trying to codify that understanding into a systematic, rules-based process to create durable portfolios. The overarching goal is really to create a holistic suite of products that helps investors of all sizes navigate macroeconomic cycles. So whether you're looking for big picture economic cycle analysis or you're just trying to look how to trade next week, we got you covered. Reflecting on my journey a little bit, it's funny, but it seems like my life experiences and my professional experiences have kind of prepared me to start Prometheus. So prior to starting Prometheus, as you mentioned, I have a background from both the institutional buy side and the retail sell side, and a lifelong passion for markets. I think I bought my first stock when I was 13. And so I started my career on the research team at a macro hedge fund called Light Sky Macro, like you mentioned. And then I continued in a very different setting at a retail brokerage called FXDD. And I think that these experiences were, in some ways the complete opposite in terms of the pace of life and in terms of kind of the demands of the job, but they were extremely complementary. And, my time on the buy side, it really gave me an insight into, how elite macro finance actually works and, the tricks of the trade and what it truly takes to have a durable edge in markets. And on the other side of the coin, I think my time in research really gave me the breathing room to be a little bit more creative, innovative, and also understand the needs of a much broader population than just institutional finance. And over my time, what I realized is that there's an unreasonably large gap between institutions and individuals, particularly when it comes to macro. So in mid-2022, I decided we're going to close that gap, and we launched Prometheus. So there's, we're a 2-person research team and growing, and it's been a great experience so far. 2022 was definitely the year to do macro research, and we've been able to help a lot of people navigate a pretty tough cycle through our work. And we plan to keep doing that, which I'm looking forward to doing some more of today with you guys.
Awesome.
That was a good summary.
Yeah.
One thing that's always, I've long been a passionate follower of macro and keen observer of macroeconomic modeling. I've always wondered how you navigate the tension between the market's tendency to, the market is always discounting what it sees in the future, right? So, agents in the market are themselves observing what's happening in the economy, and then they're using their observations with their own set of models to guide their investment decision, putting real capital to work on a day-to-day basis, sometimes a minute-to-minute or second-to-second basis. How do you navigate the tension between the market as a forward-looking discounting mechanism and the utility of macroeconomic series, like series that guide growth expectations or inflation expectations, et cetera? Any general comments on that?
Yeah, I think that's a very interesting and kind of relevant discussion to be had, right? As a macro investor, the ideal state of the world tends to be a situation where there is something in the future that you can somehow estimate, which is just not priced into markets. And I think the important thing to recognize when doing that is, first off, it's going to be really hard, right? Because you're talking about a complex dynamic system, and actually accurately forecasting in any meaningful way how it's going to evolve is going to be really hard. And then I think that what really lends itself to you being able to do that is having a comprehensive approach that allows you to roughly estimate when you're going to have second derivative changes in economic conditions. And so what we've generally found in our work is that, yes, indeed, markets are discounting mechanisms that tend to be forward-looking. But what there also seems to be is that markets have a tendency to extrapolate very current conditions almost linearly into the future. And so if you can manage to understand what the likely gap between a potential acceleration and what's discounted in terms of a linear path, that is really kind of the opportunity set that you're going for in macro. And so I think that if you look through time, the largest economic surprises in history tend to be more along these lines of these second derivative changes rather than some sort of, straight linear path that can be easily extrapolated by markets. So a good example of that, I think, would be, say, inflation in the post-GFC era, where, all you needed was a simple ARIMA model, right? And all you needed to do was extrapolate out 2% for near a decade. And as a result, inflation volatility was, not an impact on aggregate markets or portfolios or anything like that. But the second you have this state change of, inflation meaningly moving away from this, kind of stable mean, that's when you start to have these real changes. And so that's what I think is really what we try to get at, is understand those, those state changes in the trend.
I like that. So I think it was Mark Yusko who calls it a variant perception, right? It's the delta between your estimates of where growth and inflation or whatever other variables you're forecasting are pointing and what the market is discounting. And I think, well, I'd love to hear your thoughts on which side of that may be more or less difficult than the other. My intuition suggests that it's often harder to determine what the market is currently discounting than it is to forecast the first or second derivative of economic of the trajectory of economic variables. But I could be off. Any intuition there?
So I think from what we've seen, it's kind of the opposite, in the sense that I think that what markets are discounting, right? You can do it one of two ways, right? So one is the ex ante way of doing it, right? And then there's the ex post way of saying, like, could we have in history kind of understood how this worked? And so what we've seen in our study is that most economic data surprises, right? And so the economic data surprise is really what captures the difference between this acceleration and this steady state. And those typically tend to happen just in a case where there's some sort of nonlinear move. So you tend to have some amount of stability in expectations. And it's when you have data that evolves dramatically different from those expectations that you have essentially a re-rating of those expectations. And so I would say that the expectations component is fairly stable until it isn't, right? And what usually ends up marginally moving it is some kind of, acceleration or impulse in the actual data. And so what you're trying to do in a very ideal state of the world is say, I have some way of knowing when that state change is going to be, which is going to force this re-rating of expectations.
Gotcha. Okay.
Yeah.
So the idea, I think, if I'm understanding it correctly, is you have a data series, let's call it a macroeconomic data series. The market tends to extrapolate the most recent, let's say, year-over-year path, or quarter-over-quarter, or sometimes month-over-month, depends on the data set. But that it's generally a process of linear extrapolation, right? Mm-hmm. And if you've got a more sophisticated model that is giving you high confidence that the market's linear extrapolation is actually quite a ways away from how the actual trajectory of that variable is going to evolve, then you have a delta between your expectation and market expectation that can potentially be acted upon in order to anticipate expected market movement. And you're not actually trying to price, what the market is currently discounting directly from looking at market pricing, but rather you're discounting the market's expectation of each individual economic variable in determining how your forecast differs from the market's forecast based on linear extrapolation.
Yeah, exactly. And so, as we get closer to the present and more recent history, you have better and more comprehensive data of what market's expectations are for given data sets. So, whether it's payrolls, whether it's initial claims, whatever, what have you, right? So as we get closer to the present, we have more and more comprehensive data in terms of what market's expectations are. So you can actually back out, what market's expecting for your GDP. You can, if you know how to do those calculations, right? And what we find actually, which is a very interesting thing, is if we simulate, what that expected path is relative to what most recent history is, those things actually track very closely. And so what you end up with is, if you're really trying to capture these, these state changes, what you really need to be tracking. So if I wanted to create a synthetic version of this economic surprise, what I really needed to be tracking really is the acceleration or the second derivative in economic data. And I think that that's the thing that is not very well appreciated in terms of all the people that are very focused on the second derivative in data. But I think that this is kind of the underlying mechanism that makes that second derivative very powerful.
So,
Gotcha.
Aahan, I'm curious. What data, what kinds of data are you using in your models, in your modeling? What kind of data are you using to, or rather, are you using to inform your algorithms in terms of making sort of forward-looking calls on what's happening in the market? How does that work? So what data do you use, and how do you teach the algorithm? How do you teach the AI or how do you teach your process to find anomalies?
Yeah. So a good deal of our process is proprietary. But I will stay at kind of like the high level conceptual, how we go about it. The way we think about, forecasting conditions is that what we want to do is we want to create as high frequency a picture as possible of essentially how three things are evolving, for various facets in the economy. It's the current income or the current impulse to a particular indicator, right? So we want to see whether conditions are accelerating or decelerating in the current environment, because shocks in economic data potentiate shocks in future economic data or in other economic series, right? The second component we really want to measure is we want to measure expectations and whether those expectations are moving. And so those expectations can be obtained from various types of survey data and other expectation related data. And then finally, what we want to do is we want to understand whether there are any cost of capital shocks, right, occurring. And the combination of these things is where we try to triangulate how future conditions are going to evolve. Now, this framework is more applicable to certain segments of the economy and less applicable to other segments of the economy. So, more income-driven segments are less supported by this sort of framework, and more probably rate-sensitive sectors are probably more supported with this sort of framework. And so what we're trying to do is we're trying to constantly get, as incremental data comes in, we want to keep updating what our estimates are of these current conditions that potentiate future conditions. And that's kind of how we go about our forecasting process.
Okay. And so what's your model telling you right now? Like, is it possible for you to show sort of an end product, like an output from your process that you use today to inform the portfolio construction process?
Sure. So, I don't have a visual on hand right now, but we can link our latest month in macro report, which is basically a really extensive report which covers all of the dynamics and our forecasts and stuff like that for many things. And so,
Aahan, I'm curious to know, on one side of this is all the math that you're doing and all the processing that you're doing of all this data. Mm-hmm. And then, on the other side is the end product. And that's the what is that? The golden goose. That's the magic, right? That's what you want to bottle up and sell. And so go ahead.
Oh, sure. So, in terms of current context, where we think we're headed, right, is we think we're headed towards a situation where we're likely going to go into a growth contraction, right? So we're tracking GDP right now, as of, I think, last week, of about 1%, right? And, you can give or take about 20 basis points around that forecast. And we're tracking economy-wide, so that's a little bit broader than just personal consumption kind of inflation. We're tracking economy-wide private sector inflation at around 6%. And so where we think we're headed over, let's say, the next 6 months is a situation where the growth number is going to be contractionary, right? So we're looking at something where between -1% and -2% over the next 6 months. And an inflation picture where we'll settle at an economy-wide kind of inflation print of about 5%, right? And the real impetus that's driving that is as follows. So we engaged on a monetary tightening, and what we've seen so far has been a little bit of an organic pullback in cyclical activity, right? So durable goods, housing, autos, these things have kind of had partly idiosyncratic and partly, cyclical pullback, right? Because you had an overconsumption of these items during an expansionary phase. And as we kind of pull back on that, you've seen some slowing and mean reversion to trend. And that's, that slowing is part of the slowdown we're seeing. And at the same time, we've seen the net worth impacts of monetary policy tightening, but we are actually not yet at the point where debt service burdens have actually filtered through the economy to be meaningfully impactful on activity just yet. And so as we move forward in this tightening cycle, we're likely to see more sensitive areas feel more stress from this tightening in their debt service relative to income, right? And that is what is going to push us towards kind of a contractionary condition. This comes alongside, an extremely tight labor market, and potentially, this is something that we don't necessarily have too much visibility on, and we're working on developing, but we don't necessarily have too much visibility on the secular inflation picture, right? And so we're likely looking at a situation where we probably enter a recessionary condition which looks and feels slightly stagflationary. And at that point, we'll have to see, how policymakers make choices and where we'll end up from there.
Interesting.
So what part of the economy is likely to be most sensitive and to react most promptly to an increase in debt service burdens? I mean, one of the things that housing gets a lot of attention, but I mean, the reality is the vast majority of homeowners with a mortgage locked in at much lower rates. So if anything, we may see a stagnation in labor mobility, but it's unlikely to have a meaningful impact, I would think anyways, on debt service from mortgages. So maybe is it cars that are turning over? What other areas of the economy are likely to flash warning signals as being affected by that most quickly?
Right. So I think that I think the housing thing is actually is probably a very good thing to discuss. And so when we look at housing today, what we're seeing is, we're seeing aggregate housing activity actually contracting, right? And we are seeing construction begin to slow quite meaningfully. But what is incongruent with the housing activity picture is the employment condition in housing. And so if we look at, there's an intrinsic link across the economy between total, output and activity and employment, because the purpose of employment is to generate activity. And so, if you have periods of time where business sales and output are actually contracting, they eventually always result. Since 1966, we've had probably 9 instances. Every single one has led to some form of employment contraction. And so if you actually go down to a sector by sector basis, that rule basically holds up roughly well. And so what we're seeing in housing is a situation where activity has begun to contract, but it's not uniformly distributed. So the areas where we've begun to see activity contract is construction, right? But construction of single family homes, not multifamily homes. And so what you're saying is indeed correct in that a lot of people have secured financing in the past to purchase new homes, but then there's also the fact that construction needs to happen with ongoing financing. And so the bleed we're likely to see over time is that as new projects seek financing, they're going to be doing so amidst lower and weaker incomes and run up against the hurdle of higher financing, especially these larger projects, which probably need to turn over their financing at a slower rate than the single family homes which we've seen so far. And so the pressure that we have on the economy today, the most significant one, is in the form of housing employment, and particularly construction employment, being very elevated relative to the activity that we're seeing in that sector. And so if we play out where we're likely to go, it's unlikely that construction activity can remain as buoyant as it's been, even though it's not been particularly great. And that was likely to catalyze some form of weakness in construction activity and in construction employment. And so what's really important to recognize about construction employment, which is part of a broader set of employment, which is like cyclical employment, right? Is that during economic downturns, cyclical industries account for almost 100% of the variation in employment. So, people are looking to tech jobs and professional and business service jobs and IT consulting jobs and all these jobs to look for weakness. But if we go back almost every recession in recorded history, it's these leverage sensitive, cyclically sensitive areas that catalyze weakness. Now, I think that what is really important here is to realize that it's not even an outright contraction in these sectors that's required to generate a contraction in GDP. It's a slowing of employment in these sectors. Because the current setup that we have for economic growth is one where GDP is predominantly being driven by a strong consumer, which is being driven by an excessively strong labor market. And to the extent where if we do an attribution of real income, so real incomes can come from either real wages, they can come from the number of hours worked, or they can come from the amount of employment that you have. When we actually look through the attribution, you see that labor, the growth of labor and employment, actually accounts for more than 100% of income, which means that the other parts are actually contracting. And so what you need actually to push aggregate income and aggregate consumption into a contraction is just a softening of the labor market, which would be entirely consistent with history and also consistent with the cyclical dynamics that we're seeing today. Yeah.
Well, I mean, we can't really get much tighter in terms of the labor market, right? So
exactly.
So any weakness at the margin, are you suggesting that any weakness at the margin, if we move from, what's the unemployment rate at the moment? 3.5%, which is, I think, a 51-year low or something close. So, 3.6 or 3.7% would obviously be a softening in the labor market, but we would still be at 30 or 40-year lows in terms of unemployment, right? So I think what you're suggesting is that we can still have a contraction, like a recessionary contraction, even though unemployment is still extremely low relative to history.
Yeah, absolutely. And so I think this is a good point that you bring up. So what we did was we extrapolated, just to get a sense of like how much more of this can we do, right? We extrapolated out the most recent 3-month trend in unemployment, which includes 2 very soft prints and 1 extremely strong one, right? And so let's say reality lies somewhere in the middle in terms of where where employment growth trend kind of lies for that. And we extrapolated those out, and we just projected that over a couple of years. And on that basis, we will reach an unemployment rate of sub 2% by the end of this year, which would be probably one of the most unlikely things ever. Never say never. But all arguments point to 2% being some natural rate of unemployment and such. And so it seems very unlikely. And then when we go back and we essentially look at analogous periods in history, right, which where we have very tight labor markets like we have today, right, and economic activity kind of slowing, what we've seen is that employment doesn't accelerate. Like the rate of gains of employment don't accelerate as we get into a tighter labor market. They in fact slow, right? Mm-hmm. Because it's harder and harder to find, applicable work and things like that. Yep. And so if we actually modify those numbers to be something closer to what is consistent with history, right, and project out a reasonable rate of labor force growth, we actually end up at a higher unemployment rate. Right? So something closer to, 4-ish%. And so I think that the impact of those changes is a contractionary impact on consumption spending, which is the largest component of GDP and GDP growth in today's setting, which, reinforces kind of a downturn. And so what is really important about the beginnings of unemployment or the initial layoff phase is that what it really does is it removes economic entities from economic activity, right? So, a worker is somebody who receives income and who also, spends on consumption, which fuels business income, which allows them to invest. And so when you have this firing take place, what you do is you essentially, just extract a chunk of GDP. And when you reach that point, which we're more and more likely to do based off the trajectory that we're on, you keep potentiating the likelihood that GDP will eventually see this, sudden kind of melt up. And so what is really important about that is that unemployment spikes are very sporadic. It's almost like the VIX, right? So if you actually look at the changes during recessionary periods and unemployment, the magnitude of changes is maybe 3 to 5 times the size of a typical move during an expansionary period. And that's this, this economic flywheel kind of thing happening, right? Where it's a self-reinforcing spiral downwards. And so, yeah, I definitely agree with the idea that there's not that much more the labor market can do for us.
Okay, so we've started to see, if anything, a reacceleration in several important sectors and in general consumption and in several inflation metrics. How does that play off against your general kind of weakening thesis?
So I think it was actually a very interesting month in that sense, right? So we came into, when I say month, I mean January's data, right? So it's mostly January's data that everyone's looking at. And so we came into the year with everyone...
The January data that was reported in February.
In February,
yes.
Yeah, exactly. So that's all the most recent data you're seeing everywhere for retail sales and inflation and all that stuff.
Yep.
And so I think what's really interesting about it is, we came into the year with these broad measures. Retail sales was down in December, it was down in November, consumption was down in November, down in December, and all of these things. And I think that what's important is to really track back what drove this impulse and this change, right? And so the biggest change that we saw in January was a dramatic rise in employment, right? Now, what this dramatic rise in employment did was, so first off, this dramatic rise in employment was concentrated to one sector, professional and business services sector, which is basically, high skilled, you think about, accountants, lawyers, tech workers, things like that. So this one sector accounted for, I would say, more than 60% of the gains in employment for that 1 month. And at the same time, that sector also saw the largest increase in hours worked. So there was a spike in the number of hours worked, and there was also a spike in employment. You could argue probably, this is a little bit hand-wavy, but you could probably argue that there's some relationship between starting a new job and working a few more hours. But, maybe not. I think that
there was the story today that Elon Musk fired the woman who was working, who's actually responsible for making the move from free to paid, the verified accounts. Yeah. So apparently she was spending nights at the office. She was sleeping in her office in order to show Elon how dedicated she is, and he fired her anyway.
Wow.
Along with more people, along with more Twitter people. But
maybe after listening, this February data is going to be a little bit different, huh?
Yeah. Speaking of people putting in more hours in their jobs. That's what it made me think of that today. But go ahead.
And so in any case, so the massive impulse that you saw, to nominal income, right? So to personal income, came from this dramatic rise in employment and hours worked in this one sector, right? And what that did was it flowed through to nominal spending in other sectors. So once this employment rose, there were larger incomes, right, due to employment. As a result, you didn't actually have a very large increase in wages, right? So in fact, real wages remained in contraction, right? And so that flowed through to an increase in spending, right, which supported things like retail sales, which ends up in the consumption data. And all of this, right, happens alongside, and this is, I think, a big part of the conversation that we probably need to have, happens alongside an amelioration in liquidity conditions, right? And so you have economic data which improves on the margin because of this pulse from employment, which leads to a pulse in nominal spending, which supports inflation, right? Because it's just it's output versus the amount of nominal spending. And I think it's also important to realize that this massive pulse in employment didn't lead to some crazy inflation number. It was a consensus expected inflation number. It's 50 basis points, modestly pretty strong relative to recent history, but not that strong in the current context. And so, what these two things did was survey data is typically is pretty coincident with asset price data. And so you see this increase in employment and activity numbers coming from just increased employment. And alongside that, you have an amelioration in liquidity conditions, which helps prop up asset markets. The combination of these things, it creates a picture where, oh, wow, conditions look really good. But the question is, how much of that do you think can keep happening as you go forward? So as we've talked about, it's highly unlikely that this pulse from employment can keep continuing. In fact, if we do this, the most recent month-on-month print in employment, and we extrapolate that out, we'd be at 1.5% unemployment by mid-year. So it's pretty unlikely that's going to happen. When it comes to liquidity, I think that's a bigger question that I think we probably need to start with some conceptual grounding before we get into exactly what happened with the liquidity picture. But I think that's kind of the way we've interpreted recent events from our tracking of conditions.
So January was an anomaly? Is that?
I would say it's just another stage. Yeah. So, I think it's just another step. And so, you need to see much more sequential data evolve like this to have a meaningful, this is a completely different world. And so what we think is probably it was most of it just employment. And when we play out employment, we don't think it's likely to continue the way it's going so far.
Yeah, but these are elements. These are waves. These are things that are coming in waves, but the waves that are coming behind, sometimes they're bigger, sometimes they're smaller, but overall they're declining in your model. Okay.
Yeah.
So, just to be clear, labor doesn't need to, or the unemployment rate doesn't need to decline. We could just stay here, right? And for example, we could see a pickup in hours worked. We could see a pickup in wages. But if hours worked and wages stay relatively constant and the unemployment rate stays around the current rate, what would that do to your economic growth contraction models, right? I hear you that we're unlikely to continue to extrapolate the current employment trends and get to a 2% unemployment rate by January or February 2024. If we just kind of bounce along this trough here for a little while, how does that play into your models? What are some of the other variables that might play off this and offer some surprises either to the upside or the downside?
Sorry, Aahan, before you go, I just wanted to bring up there was a pretty interesting McKinsey paper recently about productivity increases, possibly being a potential solution to inflation and debt. I don't know if you saw that, but that was maybe a week or a week and a half ago.
I haven't, no.
Adam just reminded me of it, but it was an interesting paper that McKinsey points out that a productivity increase from, I think, the current mid 1% rate to somewhere around 2.2% productivity increase across the board would add $10 trillion to the economy. And so anyway, I think that might be a variable that Adam is maybe asking about, like how does productivity gains, like more hours worked or more productivity overall, change your model?
Sure, and so I think that productivity is likely to be a much more slower moving variable in this broader context. Like the way we look at productivity is over much longer timeframes than, what we focus on in this kind of context is much more what's happening with more real-time measures of just activity as opposed to what is the underlying productivity trend. And so that's the productivity aspect of it. I think, Adam, to address your what if unemployment rates stay stable, right? I think that what we have to think about is the fact that unemployment rates are a function of the rate of change of employment and the labor force, right? And so currently, right, we are in a state where I would say that employment is about 50 to maybe even 75 basis points faster than labor force growth. And so for us to actually have a flatlining of unemployment rates, we'd still need to see still need to see employment growth decelerate. which is still a step function lower. So unless you, for some reason, expect labor force growth to accelerate by 50 and 75 basis points, which is pretty unprecedented. Even with, say a comeback to work type situation, which is somewhat happening, right? We've actually seen that, there's a pretty tight band around which labor force growth actually operates. And so the likely balance is, if you want unemployment rates to stay flat, it has to still mean employment growth has to slow. And so what that does, if employment rate growth still slows, you still have this combination of, slightly slower employment growth, contracting wages, and maybe like flattish hours, which net is still worse, right?
This is such a tricky environment. There's so many reflexive variables,
Sure.
And there's also variables that we haven't really seen since the last pandemic. For example, one of the things that has been sort of widely observed is excess retirements, right? We had a much larger number of 55 to 65-year-olds leave the labor force from 2020 through 2022 than would have been expected through the trend, if we just sort of extrapolated the very steady trend that we'd seen over the last 30 years. And over the last little while, we've been able to, there was some ambiguity about what the primary drivers of that excess retirements were, right? There was some speculation it was maybe long COVID, et cetera. I think we're triangulating on the fact that actually the largest explanatory factor was, windfalls in wealth, especially in housing, right? Just people were a lot wealthier a lot sooner in their career than they expected to be because of windfalls in housing and other asset classes, their general sort of investment portfolios. And so they felt that they could retire, and maybe, there was a catalyst. They'd already been off from work, et cetera, right? So there's a lot of intermingling variables. As asset prices deflate, and we're even beginning to see some of that deflation in home prices, right? Do we expect to see some of those excess retirements revert, right? And so, it would be unusual to see an acceleration of in the labor force of 50 to 75 basis points, looking back through the long-term history. But in the context of the current environment, which has already had these weird dislocations, maybe that's possible, right? And then, so I'll stop there. I do want to come back to excess savings, which is another really unique variable that I think is meaningful in this cycle. But let's talk maybe about retirees returning to work.
Right. And so I think that what you're highlighting is true, right? Like that there's definitely been some amount of pressure. And so what I will say is that, you did see some of the impact in this, in this retirement in terms of the dwindling of the labor force, right? But even that, right, I don't have the numbers in front of me, hasn't been such a, and so I think that even if we were to reverse that deceleration in labor force, right, over time, it would not be such a meaningful reacceleration in labor force growth that it would overpower the speed at which employment growth is currently moving. And so I think that, yes, you're probably right. And the answer is never black and white, right? There's probably some truth in between what you're saying in terms of, labor force participation increasing and what I'm saying in terms of labor force participation is probably flat and it's employment that's the one that moves. And so when we net those two out, it's still a situation where at best we can imagine a flat labor force, right? And so an unemployment rate that's flat. And so I think that the combination of which one moves it is very meaningful, right? And so now if we take the current rate of growth of employment, which is going to be very hard to sustain, but even if we sustain it, the question is, are wages and hours going to, maintain their current pace, right? And so I think that brings us to the profits question, right? And so what we're seeing so far from publicly reported companies, right, is that companies are beginning to feel a little bit of a bite in terms of their profitability. The main drag on profitability is largely coming from companies' own reinvestment. So, if we look at all the sources of profits, right, you can have it coming from, profits are essentially a function of the relative savings of non-business parties in the economy. And so when we actually look at that attribution, what we're seeing is that the financiers of profits are households today, right? And the biggest drag are actually businesses themselves, right? And so what we're seeing now is a situation where profits have begun to contract a little bit, and it's unlikely that given these monetary policy cycle dynamics that we're talking about, that we're going to see a massive rise in gross investment in the economy. And so as a result, the squeeze on profits is on and is likely to worsen, which means that there's a higher likelihood that the things that businesses do control, the first two things that they try to control before they actually try to control the amount of labor, is hours and wages. And they're going to try to claw back as much profitability as they possibly can. And, if the profit condition ends up being, exceedingly bad, that's when they really revert to the firing of employees. And so, when I square away all these things, it looks to me very likely that the income story is likely to deteriorate, which means the consumption story will deteriorate, which means the GDP picture will deteriorate.
Interesting.
Yeah, I think there's a general consensus that the Fed is going to have to catalyze a recession, even if it's just shallow, in order to rein in inflation expectations. The big question is, how high are they going to have to raise rates, and for how long? How long are we going to have to wait for the excesses in the market that are probably exogenous to normal cyclical activity, right? We talked about the excess retirements. We talked about excess savings, from massive fiscal expansion in 2020, 2021 still playing through. How long these exogenous factors, which, let's face it, it's impossible to factor into macroeconomic models because there's no historical precedent, right? Unless you go back to sort of 1919, how long it takes for these factors to play through. Then there's also this variable of whether raising rates, you've got the MMT people who pretty consistently say that raising rates means that you're paying a lot more interest into the economy, right? And that excess interest flows through as income, right? Which will impact consumption. Now, typically,
I don't want to interrupt you, but if you actually track the interest, the impact is not that meaningful. So
it's not showing up yet.
I mean, in the sense that the size of interest transfer that actually happens from these payments is not meaningful to cause the kind of inflation that people think. So if you actually look at personal interest payments, that are received by households from all entities, including the Treasury, they are less than 1% of income. So conceptually very strong, but when you actually bear it out in the data, it's like, probably not.
I hear you, but all of the effects that we're talking about are at the margin, right? And
sure.
All of them, each of them on its own is a small effect, right? If all of that income were to go away, right? It's 1% now, it was 0% a year and a half ago, right? because rates were zero, right? So, that's a very large bump in excess income at the margin, right? So,
right.
I'm just saying that there are a lot of sort of competing dynamics here. The question really is, there's lots of questions, but I always sort of think, to try to distill it, is there more strength in the economy than most people think? If so, is the Fed going to have to raise rates higher than everybody thinks and for longer? If so, are they also going to need to, or have permission or the ability to, drain liquidity from the system at the pace that they have already declared that they're going to drain it for like the next 3 years? If all those things come to fruition, it doesn't, this is the weird competing dynamic right now. A strong economy, everyone thinks, oh, great, that's fantastic for earnings. And that actually might be, notwithstanding margin pressures and all that kind of stuff. But if it requires the Fed to raise rates much further than everybody thinks, and to drain liquidity, collaborate with the Treasury to drain liquidity at a much faster rate than anybody thinks, and or affects credit creation, then that could be highly deleterious to stocks, even in the face of an unexpectedly strong economy, right?
Yeah, and so to talk a little bit about kind of the the earlier part of the conversation where we touched upon the lags and the impact of liquidity injection. So I think that what has really happened over the course of many cycles in the economy is that we've had a recomposition of the economy slowly and gradually, right, towards a services-oriented economy. And what that's done is so if you think about the time when, manufacturing and industrial output and things like that were a large part of the economy, leverage and the ability to leverage was also exceptionally large, right? So our ability to add debt to facilitate output and, to also facilitate consumption in some cases was very large. And so the cyclicality that most people refer to is basically a sensitivity to interest rates, which is usually a change that is brought about by the Fed. And so what you've had over time is you've had a recomposition of the economy to more of an income economy than a debt economy, even though we have high levels of debt, which seems kind of counterintuitive relative to all the narratives that you hear. And so today what we have, particularly after the type of stimulus that was done in the COVID recession, which was a pure income injection, right? It wasn't a credit injection where the Fed, decreased interest rates, which allowed for a lot of lending and borrowing. It was a pure income injection, right? And that pure income injection lends itself further to this recomposition, right? And so the problem that a lot of more traditional models are dealing with now is that a lot of early indications are developed based on these cyclical indicators or, how do they react to monetary policy? So durable goods react to
economic indicators, et cetera.
Exactly.
Yeah.
So durable goods reacts to, interest rates, which means that, eventually it's going to somehow impact aggregate activity. But over time, durable goods just becomes a smaller and smaller part of economic activity. So the severity at which durable goods needs to contract now is so much larger, which means the Fed needs to do so much more. And so I think that when we started 2022, we were actually on the path to doing this absolutely right? In the sense that you actually had fiscal contraction and monetary contraction happening at the same time. And so the problem we have today is a money and income problem. It's not a credit and debt problem, right? And so to be able to reverse those conditions, now the Fed has to essentially go it itself alone, because we did have a little bit of, fiscal surpluses and things like that, but that wasn't entirely on purpose, right? So as a result, what you have to do now is you have to impact these cyclical sectors so adversely and so much that the Fed will probably have to go further. And it's because this, you can think of it as a relative beta of the economy to cyclicals has just reduced over time because of the relative weighting.
Right.
And that's kind of how I would think about, navigating the cycle and the relative strength. Because if you look at what's happening to a lot of economic forecasters, the traditional cyclical signals have all triggered, right? ISM is down, manufacturing is down, durable goods, housing, interest rates are up. But it's the relative sensitivity of those things and size of those things that's probably going to prolong this cycle, right?
Yeah, so very, very interesting, Aahan. I think I want to ask you, so, you have all this algorithmic work happening to identify these economic trends. And then, at the end of it is the end product, which informs your investment decisions. How do you make money? How do we, as investors, what's your model telling you to do from an investment standpoint with all this information?
Sure. So maybe I can give some context in terms of how we think about kind of the investment framework, right? So obviously we do a lot of economic forecasting on three major variables that we believe define economic cycles. So we believe that the combination of growth, inflation, and liquidity are what define economic cycles, and it's permutations of those things that determine where you are in the cycle and where you're likely to go. And so, we spend a lot of time trying to forecast how these cycles are going to develop. right? And that kind of sets up our fundamental picture. And from there, when we start transitioning into how we're going to weaponize this and look at markets, right? What we think is very pertinent for any investor to realize is that irrespective of how good your models are, how high frequency, how much data you have, as a fundamental forecaster, you're likely to be very wrong very often, right? So you can have a 40, if you're the best of the best in the world, you'll be wrong 40% of the time. If you're having a bad year, it's going to be 50, 60% of the time. But, so if you're pretty elite, you'll be 55% of the time, you'll be right. And so actually living through being wrong 45% of the time, especially if, those are in a sequence, is remarkably painful. And so what we try to do to ameliorate that is we do what we call market regime confirmation. And so what we try to do is we try to understand what markets are pricing in terms of regimes for growth, inflation, and liquidity. So we look at, what are markets implying, and we try to understand where markets are beginning to price the conditions that we expect to evolve on a fundamental level. And what that's really allowing us to do is just to be a little bit more pro-cyclical in our allocation rather than just being outright counter-cyclical, which just helps with the smoothness of returns, right? And then on top of that, we use a variety of timing factors, which are, consistent with more traditional, mean reversion, trend, reversal, breakouts, things like that, to help us essentially create return streams that are stable, but also, I think, importantly, that are impervious to, any particular regime or autocorrelation structure. So, is vol up? Can you do well? Is vol down? Can you do well? Are returns autocorrelated or are they inversely correlated? Can you do well in all of those? And those are kind of our timing tools. So we look at, a universe of 37 ETFs, and we pass each one of the ETFs through this universe, and then we, enter kind of a portfolio construction where we try to cap our maximum volatility in order to cap our max drawdown. And so that process today, right, I think it tells you a couple of things. So I think it's important to keep in mind that our positions turn over weekly. So, we have a relatively high frequency. So, we could be in or out of positions depending on how conditions evolve. So, right. But what I think just the general takeaway is this, that we think that economic conditions are likely to evolve poorly. But from what we're seeing from markets is that there's a lot of cross currents and mixed messaging, right? And as a result, what we're also having is a large amount of volatility, which is a function of this tightening liquidity environment that we're in. And so what happens during these tightening liquidity environments is that, asset correlations tend to become closer and tighter. And as a result, a lot of diversification benefits in your portfolio tend to evaporate when tightening liquidity is like the main factor driving asset price performance.
Right.
And so during this time, what you actually need is you need a lower total gross exposure to achieve your volatility objectives than you would otherwise. So, if you needed, 100% equity exposure to achieve a 15%, equity vol mandate, now probably you need something like, 50, 75%. And so we're seeing that across the portfolio. And so I think the most salient thing that we've seen over, let's say, the last 4 months is, maintaining just a very high level of cash, which, today more and more is actually allowing you to even recapture inflation. So it's kind of a paid to wait thing, right? Mm-hmm. And at the same time, I think that, the tightening liquidity components are favoring things that are way more relative value than absolute beta. So, things like, maybe perhaps FX, like the dollar, or, things like, being long bonds, short stocks, or some combination of those things. And so it's a time of uncertainty, and it's a time of really just managing your vol and risk. And that's really what we're seeing. In terms of actual positioning right now, heading into this week, we've just been long the dollar and long T-bills. More generally, starting this year as a more tactical kind of play, we were long 60-40, betting on a little bit of disinflation and inflation vol coming down. Right. I think more broadly, I think the way we think, from a more discretionary perspective, I think the most interesting trade to me personally is initially being short the 2-year on a little bit of repricing of overly zealous, we're going to get to cuts. And then eventually, as we get to economic deterioration from employment data actually being long bonds, right? I think right. I like those sets of things, but I don't know whether those things will actually enter the portfolio. So
yeah, the 10 year is definitely shaping up for an opportunity.
Sure.
Yeah. We're winding down, but before we do, I just wanted you to have a chance to talk about it. You're describing, I think, your ETF portfolio model, right?
Yeah.
And it just occurred to me, I was reviewing the methodology, which is a great methodology document, by the way, recommend it. And just in the context of the conversation, I was curious, you're using economic indicators, your own proprietary recipe of macro indicators to divine the growth, inflation, liquidity dynamic at any given point in time. And I guess because you sort of have simulated this process back through sort of the 1970s, just based on your statements about compositional changes in the economy over time, just wondering how, because we've done some thinking and some probing on the macro indicators ourselves as well, and we've been sort of asking the same questions. As the composition of the economy changes through time, how do you think about employing these macroeconomic indicators and deriving signals from them as their relative importance changes based on these compositional changes?
Right. And I think you're getting to the heart of really like the challenge of any macroeconomic forecaster, especially if you're systematic, you know. I think what you want to do really is, in an ideal state of the world, most people would have developed this understanding of this relative beta, you know, so to speak. So if you're, you know, using durable goods as your leading indicator, you know, I'm just using this random example again and again, but yeah. So I think that what you want to do is something that, to steal your own language, I think that you need an ensemble of reliable things that are adequately diverse. And so even when you're trying to triangulate economic conditions, what you have to realize is that one set of indicators, if they are all the same and they all tell the same story, they are unlikely to be meaningfully additive to a process. And so what we try to do by looking at, you know, I think the main ingredient that we try to focus on nowadays much more is this liquidity picture, right? And there are many dimensions to liquidity. And what that allows us to do is allows us to have a very broad kind of leading indicator approach, which is also adequately different from the growth indicator kind of approach, right? And what we want to try to do is really say, how many different ways can we look at the economy with a little bit of edge, as opposed to credit cycle is the only way to forecast the economy. It's worked for 80 years and we're going to keep doing that. Because that approach, because of these compositional and structural changes, it's going to run out at some point. And, you know, you look at, I think there was a time where nobody knew probably what a leading indicator is. And now they are, you know, all over Bloomberg. Everyone has the charts. And so I think there's definitely, I think there's a separate conversation in terms of how many people can actually exploit that information, which I think is a valuable conversation as well, right? But I think what you want to do as a forecaster is try to say, how many different small edges can I put together that are adequately different but paint the story of future economic activity? And so it's, you know, that's what I would really kind of counsel.
It seems to me too that and I like your use of the word beta there. I think that invokes some potential modeling directions, because I imagine,
you caught that, huh?
yeah, and I can imagine that because these compositional changes occur relatively slowly through time, that you can recalibrate your indicator weights over time based on some sort of long-term moving average of their beta to the underlying things that you're forecasting as they change. So that's a neat concept. And I had another point, but I forget what I was.
Well,
I'll just go off that, to be honest.
I really liked the way that you described the give and take between businesses and households, and then ultimately the clawback that businesses are employing in terms of cutting employment, and then that vicious cycle. I like the way you described that. That was
I appreciate that.
Yeah, I think investors too often play a regular game of chess or checkers when they're investing, and they're not really playing the 3D chess that they should be playing or ought to be playing, and that goes to your comment about and my question, which was now that you know all of this, how do you make money with it? And putting the two ideas together, macroeconomics and markets. Often people think the two go hand in hand, but they don't. They don't necessarily inform one another. And so, if you can do that through your modeling, and one question I had in that vein was, when you get the economics output from your modeling, your economic modeling, do you intervene and then make decisions based on the output about what the investment portfolio should be, or does that happen
Never.
dynamically?
Never.
It's happening completely dynamically.
Yeah.
From
So
one end to the other.
we never touch anything, and really what that boils down to is having discipline, because macro is something that lends itself to or attracts people that are intellectually curious, and they have a lot of ideas about the world, and I think I'm not short of those. But I think it also attracts a crowd that there is an inherent I would say almost arrogance to macro forecasting because it's so hard, right? And so we're going to have this tendency always to want to overfit and have very, very strong recency bias and things like that. And so what we're really trying to do is say, hey, until we know for sure, we're not going to touch anything. And if we know for sure, we have to be able to systematize it. Otherwise, we don't really know, right? So if I think that, this data is going to come out because I know X, Y, and Z, unless I truly know and I can really systematize that, there's no value in it because it doesn't have any positive expected value. And so we really stay far away from the model's telling me this, but I know better, and let me front run the model. Because more often than not, sometimes you might get it right, but you don't know how many times you're going to get it wrong, and that just leads to a lot of problems.
Yeah. You want to that
error. You're singing from our songbook from a systematic thinking standpoint.
Yeah.
I remembered what I wanted to ask you about. Liquidity. We had Andy Constant on, and I'm a big fan of his framework. And one of the things that he mentioned stood out to me, and that is that the liquidity is an enormous driver of asset prices in the current environment. But until the Fed expanded its balance sheet so dramatically over certainly the last 12, 13 years, but definitely over the last 2 or 3 years, it really didn't play a very large role in asset pricing at all, right? So I'm just wondering, and as they run down the size of their balance sheet, one would presumably expect that their balance sheet will play a decreasing role over time, right? So, while liquidity is obviously a major driver of asset prices right now and was last year and in 2021, as you look forward to 2024, 2025, 2026, if the Fed is able to achieve its balance sheet normalization objectives, how do you anticipate liquidity acting in terms of its weighting as a variable in macro models?
Yeah. So, very interesting subject, and shout out to Andy. We have interacted quite a few times on Twitter. We've had him on the podcast, so definitely respect Andy's thinking on it. I think he shares some of the thinking that we have on liquidity, but we have our own version kind of how we think about liquidity. So if I can really talk about that a little bit.
Yeah.
So we think that actually what you're talking about is, the use of interest rates versus, quantitative easing, right? And how we actually think of those two things as essentially the same thing, just deployed differently. And so when we think about liquidity, right, what we try to track is we try to understand the flow of cash and cash-like assets through the economy. And what is, a cash-like asset? A cash-like asset is essentially an asset, which is somebody's liability, which has minimal risk of nominal dollar loss, right? So in essence, every asset kind of operates somewhere on the liquidity spectrum. Some assets are just more liquid than others because they have less risk. And so when you think about liquidity, there's a hierarchy to liquidity. And there are two main providers of liquidity that you can think of, right? There's the government sector and there's the private sector, right? And so the government sector, right, is the US government, which is the sum of the Fed and Treasury, right? And their liabilities are private sector's assets. So what we do is we go through a process to net out their intergovernmental holdings to arrive at the joint balance sheet. And those liabilities are the stock of assets the private sector owns. And what's important to recognize about their liabilities is that for any given duration, those are the most high quality assets, right? Because the government is the issuer of the currency. And as a result, the risk that they won't meet their liabilities is extremely low. And so why does the government actually raise debt if they can just print money? One, it's inflationary, and two, what they're trying to do is they're trying to reallocate money from savers in the economy and create income in the economy with some sort of societal good in mind, right? And what that does is it creates spending in the economy, which is a net positive, right? And at the same time, it also hands a very pristine asset to the private sector, right? So gross issuance of this federal balance sheet is a net positive. And it's in part impacted by interest rates, right? And also just the will of the Treasury. So the Fed determines interest rates and the Treasury determines how much they're going to issue. And those two things are related to each other. Mm-hmm. Now, what happened, right, which was a little bit anomalous, is that the Fed used to control interest rates, right? And that would have an impact on the Treasury's issuance, and that would have an impact on, credit securities and the corporate sector. And we'll talk about private sector liquidity in a sec. And so when we look at what they did, they embarked on a journey of QE, which is essentially a journey of maturity transformation. And so what matters when it comes to this government balance sheet is first, is it expanding or is it contracting? The more it's expanding, the more the impulse to income, which is a net positive for the economy, which is probably liquidity inducing. Next is the composition of this issuance. So if the issuance is a short duration issuance, right? So the Treasury issues bills, right? It's the equivalent to issuing cash, but plus an interest rate. And so you have this redistributive effect. And also the immediacy of spending of short duration issuance is very, very fast. So, you're not going to raise a 3-month bill to invest in a 30-year infrastructure project, right? So if you raise a bill, you're likely to spend it on your payables pretty quickly. And so that impulse circulates through the economy very quickly. Now, what the Fed essentially did was when they purchased a lot of Treasury notes and bonds, they recomposed this aggregate government balance sheet. Mm-hmm. And reserves are a highly, highly liquid asset available to the commercial banking system. And so what this combination of fiscal and monetary policy does is you expand the balance sheet and you also lead to a situation where that aggregate balance sheet is less risky, creating more liquidity in the system. And so when I think about the policy aspects of liquidity, I don't think that the dynamic has actually changed. I think that, we had the luxury, and this is just the evolution of learning like anything else, right? Like in any other field. We weren't talking about liquidity 10 years, 20 years ago, but now we are. And so I think that what's important to realize is that interest rates were always managed through reserve balances anyway. And so, the liquidity management has been integral to the system forever. It's just that we ran out of the control of interest rates and started to use only maturity transformation, right, to impact liquidity conditions. And so when I think about the future, right, we've potentiated some amount of interest rate movement, right, by increasing interest rates now. And we still have the QE, QT kind of channel, right, because you can still do bill issuance. And right. I think that when we're looking at this aggregate liquidity picture, looking at this combined picture probably has explanatory power over the entire sample. If you focus only on QE, you'll be really good post GFC. if you look at only interest rates, you'll probably be good, pre-GFC. And I think that looking forward, you probably want to have both, right?
Yeah, I guess all I'm saying is that the impact of, well, there's a lot to unpack there. But in the to distill the initial point,
Yeah.
When the Fed balance sheet, or even when the government balance sheet is large relative to the economy, then obviously changes in government issuance and maturity is going to have a much larger impact on the economy and on financial markets than when the size of the Fed balance sheet or the government balance sheet is small relative to the private sector, right? Until 2011, 2012, the size of the Fed balance sheet was minuscule relative to the size of the private sector. Now it's actually of a meaningful size. And with the massive amount of deficit spending by the Treasury over the last 3 years, the fiscal balance sheet is also very large relative to the size of the economy all of a sudden. So I guess all I'm saying is, to go back to your sort of beta language, the beta of changes in both composition and tenor of the Treasury and the Fed balance sheet should have a larger beta on the economy and on asset prices as a function of the size of those balance sheets. So as the balance sheets shrink, if they do, relative to the size of the private sector, then we should expect that the weight of those changes in liquidity to, on a percentage basis, to have a much smaller effect, right? I think the other thing I kind of wanted to dig into, and I'm now really pressed for time, but is the fact that the Fed also was really trying to play with the wealth effect by changing the composition of the term structure, right? When they absorb duration, they flatten the yield curve, and bond investors were able to eke out the required premium from the yield curve. When they flatten the curve, they can no longer get the premium that they require, the required return from investing in treasuries up the curve, which means now they've got to move into credit, right? Those then credit spreads tighten. So at the margin, credit managers who are trying to earn their required return are no longer able to get their required return, which means they got to move into, down the capital structure, eventually the equity, et cetera, right? And so this is pushing risk premia higher, or I guess compressing risk premia, pushing asset prices higher at the margin over time. So my expectation is, now, for the Fed, this is in collaboration with the Treasury, the Fed could let long duration assets to roll off, and the Treasury could sterilize those with bills, right? And it would have no impact on the yield curve, or actually serve to steepen it, which would attract assets. But anyway, there's a whole term structure phenomenon or dynamic at play here too, that has a very powerful impact on asset prices, even if it has a more muted impact on the economy, right? I mean, definitionally, we know that when the Fed, when the Treasury expands its balance sheet, it's adding deposits to the private sector. We know that that's accounting identity, right? But where the Treasury issues has a profound effect on asset prices, and those dynamics compete at times.
Yeah, I totally agree. So I think that, so high level, definitely agree. And then, so the nuance that I was trying to get at is, what you're saying is true, that the balance sheet bloating really happened in this post-GFC era, right? And what I think is really important is to recognize that that's a function of running out of interest rates. So once you flatline that interest rate, the only option you have is issuance, right? Issuance and composition of that issuance. And so the Treasury did whatever they could do, and the Fed manipulated the composition of that issuance. But in past cycles, right, the liquidity impact came from the private sector, because the Fed would reduce interest rates, and that would stimulate liquidity creation from the private sector, which was a way more pro-cyclical phenomena, right? And so interest rates would act countercyclically, but, and as a result, private sector issuance would act pro-cyclically and such. And that's how this cycle would evolve. And so I think that if you track the combined aggregate of both policy liquidity and private sector liquidity using these two dimensions of, both issuance and interest rates, right? You see a consistency of picture over time, right? And that's really what, going back to kind of that relative beta discussion that we had, indeed, you're right that the Treasury took over kind of this mechanism. But if you were to try to construct something to be able to explain the variation, right, you would need to aggregate all of these, which would make your, indicator much more reliable over the entire sample.
Sure, and you could aggregate across global central banks and
Exactly.
the global credit system and the Eurodollar system, et cetera. I guess what's interesting, right, is that in past cycles, because the manufacturing sector and interest-sensitive sectors had a larger beta on economic changes in economic growth, right, then private sector credit creation would also, that liquidity from the private sector, changes in that liquidity would have a higher impact on or larger impact on the economy, on asset prices. When we sort of shifted more to a service economy, that accelerated in the very modern context, and those more interest sensitive, higher beta sectors or more volatile sectors of the economy began to have less of an impact. Going forward, we're still in a services oriented economy. So private sector credit creation is likely to play a smaller role. So private sector liquidity is likely to play a smaller role. And both the Fed and the fiscal balance sheet are also scheduled to contract. So they will probably also play a smaller role, right? So we could be in a situation in 24, 25, 26 when, these liquidity indicators may be more ambiguous about how to read them or what their impact might be on the economy and on financial markets.
So the really interesting thing actually when it comes to this, so we have trackers for all these things. And when we look through the data, right, what we see is that indeed the public sector policy impulse was negative. But when we actually look through the private sector impulse, through 2022, it actually improved. And the reason it improved was this shock to nominal activity from higher prices, with wages not rising commensurate with the price gains, which resulted in, a net benefit to corporations, which allowed them to make debt service payments at a pretty, in a pretty comfortable manner. So if we look at lending from, say, from banks, right? So commercial banks, we actually see that lending to mortgages improved. We see that commercial and industrial loans improved. We see that residential, so construction loans improved. All this banking activity actually improved, while reserves and cash assets were drained by quantitative tightening. And so the net impact of the banking sector was actually that, the banking sector may have contracted, right? But the contraction didn't come because of weakening in pro-cyclical liquidity. It actually just came all from policy. And so we see a similar picture actually when we go out to, corporates, and there's a completely separate, let's not touch it, but intermediary lending and stuff. So, but when it comes to corporate activity, we actually saw commercial paper issuance ramp up. We saw high yield issuance in January in particular ramp up like crazy. And we saw IG issuance, all these things, which are symptoms of pro-cyclical liquidity, they all improved in 2022. And so
another explanation for that, right, is that companies were issuing in advance of, like, it was a massive rush to issue in advance of anticipating large rate increases, right? Yeah. So they built a war chest of cash. Doesn't mean it's going to get spent. It's just there's a lot of cash on the balance sheet in preparation for a long period of higher rates, where it's going to be hard to
so the way we end up looking at this is we actually try to track how much of it makes its way into spending. And so when we look at cash balances across the economy, cash balances have actually decreased. And so there are certain segments of cash balances that have improved. And so I think that part of what you're saying is true in that, and that's the liquidity creation aspect of it all, right? So when you issue this commercial paper, it essentially creates a cash balance which is used for a payable, and that payable ends up on someone else's balance sheet, and you can't take that money away if the commercial paper defaults, right? And so I think that indeed there's an element of that, but a lot of it is actually flowed through and supported activity, right? So there's likely a combination of the two, and I think what you're saying speaks to the lagged effects of policy, right? So this commercial paper maybe was the most sensitive to rise in interest rates because it rolls over so often, but longer dated debt takes a longer time for coupons to rise and things like that. And so I think that part of it is definitely, trying to lock in interest rates at a, more reasonable rate before they really skyrocket. But I think also part of it is just a reflection of nominal activity just being really strong, right? These two things are contemporaneous.
There's a lot of duration issuance too, right? And
right.
Yeah, nominal activity is strong because inflation is strong, right? So if you're issuing a bunch of debt, and obviously, if you've got year-over-year inflation top line in the 7-8% range, then you're going to draw down your borrowing a lot more quickly, right? So you're going to have a lot less savings. Doesn't mean you're actually buying more units of goods or services, but it just every unit of good costs more, right? So you're going to draw down saving.
Sure, indeed. And so, you've had real activity tank, but at the same time, like, the purpose of nominal borrowing is nominal spending, right? So you finance your nominal purchases with a nominal dollar borrowed. And so I think that the likelihood, kind of peering around the corner, right? The likelihood that we continue to have this pro-cyclical liquidity continue the way it has is very, very low. And then you enter this regime of, oh, wait, so we have quantitative tightening ongoing. We have a treasury that's probably trying to be a little bit more responsible, right? Like, I think that's probably a fair assumption. And then given these cyclical dynamics, the pass-through of monetary policy, the pro-cyclical components of liquidity are likely to suffer, which means that activity is also going to suffer. And that's really, one of the driving forces to why we think that economic activity is going to evolve the way that, we've discussed today.
Love it. Okay, I've got to go. I'm already 15 minutes late for what.
Aahan, thank you so much. That was an incredible discussion.
Absolutely.
And, I had so much fun, guys. Thank you.
Yeah, I'm really enchanted by your framework and the depth of your thinking. So I'm looking forward to digging more into your publications, but also carrying on the conversation live at some point in the future.
Absolutely. I look forward to it.
Now you can just continue where we left off.
Yeah, that's right.
All right, guys.
Thanks so much.
Aahan, thank you so much. Adam, thank you. Great to see you guys. Nice to meet you,
You
Aahan.
too.
Thanks for your incredibly valuable time. That was really cool.
Hey, take care, guys, and thank you so much for having me on.
Pleasure. Thank you so much.